Real estate isn't just about buying property. It's about building wealth you can see and touch. A well-chosen property generates steady rental income and appreciates over time, creating a solid financial foundation. Unlike stocks, real estate is tangible and always in demand, making it a secure investment. You don't need a fortune to start. With the right plan, anyone can get in the game. Rental income can supplement or even replace your salary, giving you true financial freedom. As property values rise and you pay down your mortgage, your wealth grows. Real estate isn't a get-rich-quick scheme. It's a proven path to lasting financial independence. Starting in real estate can seem overwhelming, but every investor begins with a single step. This guide breaks down the process into simple, actionable steps. No jargon, just practical advice. We'll cover everything from setting goals to finding and analyzing properties, securing financing, and managing your investment. Real-world examples will show you how these strategies work in practice. Success comes from education, planning, and consistent action. Let's get started on your journey to becoming a successful real estate investor. Residential rentals are the classic entry point for real estate investors. Buy a property, rent it out, and collect monthly income that covers expenses and builds profit. You benefit from cash flow, property appreciation, equity growth, and tax advantages. Landlording requires effort, finding tenants, handling repairs, but property managers can make it hands-off. House hacking, living in one unit and renting out others, lowers your costs and builds equity fast. It's a smart, accessible way to start investing with less risk. Residential rentals offer steady, long-term wealth building. Flipping is the fast-paced side of real estate. Buy low, renovate, and sell for profit. Success depends on smart buying, accurate renovation budgets, and knowing your market. The 70% rule helps ensure you don't overpay. Pay no more than 70% of the after-repair value minus costs. Wholesaling lets you profit by finding deals and assigning contracts. No need to buy or renovate. Both strategies offer quick returns, but come with higher risks and require strong market knowledge. Flipping risks include budget overruns and market shifts. Wholesaling risks, not finding buyers. These active strategies demand hustle and expertise. Want real estate exposure without the hassle? Consider REITs or crowdfunding. REITs let you buy shares in large property portfolios, like stocks, but backed by real estate. They're liquid, pay regular dividends, and require little capital. Crowdfunding platforms pool investors' money for specific projects, offering access to bigger deals. You can invest with just a few $100s, choosing debt, fixed returns, or equity, profit sharing. Crowdfunding is less liquid than REITs, so do your homework before investing. Both options offer hands-off ways to diversify your portfolio. Before you invest, ask yourself, why real estate? Define your personal goals. Be specific. Do you want extra income? Do you want early retirement? Or a college fund? Clear goals guide your strategy, whether it's steady rentals or quick flips. Write down your targets and timeline. This turns dreams into actionable plans. Your goals shape your risk tolerance and investment choices. Map out what success looks like for you. This is your foundation. Start with purpose, and let your why drive every decision. Once you have defined your goals, the next step is to take a good, hard look at your financial situation. This isn't the most glamorous part of real estate investing, but it is absolutely essential. You cannot build a solid investment portfolio on a shaky financial foundation. This means getting brutally honest with yourself about your income, your expenses, your debts, and your savings. You need to know exactly how much money is coming in each month, and more importantly, where it is all going. Start by tracking your spending for a month or two using an app or a simple spreadsheet. You might be surprised by what you find. The key numbers you need to understand are your credit score and your debt-to-income ratio, or DTI. Your credit score is a 3-digit number that tells lenders how reliable you are at paying back debt. A higher score will unlock better interest rates on your mortgage, saving you tens of thousands of dollars over the life of the loan. You can check your credit score for free through various services. If it's not where it needs to be, typically above 700 for the best rates. Start working on improving it by paying bills on time and reducing credit card balances. Lenders want to see a history of responsible credit management before they trust you with a large loan. Your debt-to-income ratio is another critical metric. It's calculated by dividing your total monthly debt payments, like car loans, student loans, and credit card payments, by your gross monthly income. Lenders use this ratio to gauge your ability to handle another monthly payment. Generally, they want to see a DTI of 43% or lower, including your potential new mortgage payment. If your DTI is too high, you'll need to focus on either increasing your income or, more likely, paying down some of your existing debts before you can get approved for an investment property loan. This step is non-negotiable for securing financing. Finally, you need to assess your savings and determine how much you have for a down payment and closing costs. For investment properties, lenders typically require a larger down payment than for a primary residence, often 20 to 25% of the purchase price. On top of that, you'll need to budget for closing costs, which can be another 2 to 5% of the purchase price. And that's not all. You must also have cash reserves, a safety fund to cover unexpected repairs, vacancies, and other emergencies. Most experts recommend having at least 6 months' worth of total expenses, including the mortgage, set aside for each property. This financial checkup ensures you are starting your journey from a position of strength.
Step 1, wake up early, gonna rise with the sun. Step 2, get some good.
Real estate investing is often portrayed as a solo mission, but the truth is that it is a team sport. The most successful investors in the world did not get there by themselves. They surrounded themselves with a team of experts who provided guidance, support, and specialized knowledge. As a beginner, trying to do everything on your own is a recipe for costly mistakes and unnecessary stress. Your goal should be to assemble your own A-team of professionals who can help you navigate the complexities of the market. This team will be your greatest asset, saving you time, money, and countless headaches along the way. The first and most important member of your team is a great real estate agent. But you don't want just any agent. You need one who is investor-friendly. This type of agent understands the unique needs of an investor. They know how to analyze deals, calculate potential cash flow, and spot properties with good investment potential. They are well connected in the local market and may even have access to off-market deals before they hit the public listings. Interview several agents and ask them about their own investment experience and how they have helped other investors. Find someone who is patient, knowledgeable, and aligned with your goals. Next on your list is a reliable mortgage broker or lender. A good broker can be a game changer, especially for your first deal. They have access to a wide variety of loan products from different lenders and can help you find the best financing options for your specific situation. They will guide you through the entire mortgage application process, from pre-approval to closing, and can help you overcome any hurdles that may arise. Just like with agents, you want to find a broker who has experience working with investors. They will understand the different requirements for investment property loans and can structure your financing for maximum benefit. Other essential members of your team include a real estate attorney or title company to handle the legal paperwork, a thorough home inspector to uncover any hidden problems with a property, and a good contractor for any renovations or repairs. As you grow, you might also add a certified public accountant who specializes in real estate to help you with tax strategy, and eventually, a property manager to handle the day-to-day operations of your rentals. Building these relationships takes time, but it is an investment that will pay dividends for years to come. Start networking now and assemble the team that will help you win the game. With your goals set and your team in place, it's time to start small and think big. Focus on one simple strategy, like buying a single-family home or duplex as a rental. Your first deal is about learning, not perfection. House hacking, living in one unit and renting the others, can jumpstart your journey. Take action, gain experience, and let your first property open the door to future growth. Securing a loan is one of the biggest hurdles for new real estate investors, but it's also where the magic of leverage happens. Leverage lets you control valuable property with a fraction of the cost. Most start with a conventional mortgage, but FHA and VA loans can lower your barrier to entry. Lenders want to see a strong financial profile and cash reserves. Get pre-approved. This is your golden ticket to start investing with confidence. Every dollar counts when investing in real estate. Build a detailed budget that covers more than just the purchase price. Include acquisition costs, repairs, and ongoing expenses like mortgage, vacancies, and maintenance. Don't forget property management, taxes, insurance, and capital expenditures. By planning for every expense, you'll know your true cash flow and set yourself up for a profitable investment from day one. In real estate, location is everything. The market you choose will shape your success more than any other factor. Even the perfect house is a bad investment in a declining area. Start in your own backyard, where you know the neighborhood's best. Look for job, population, and wage growth. These drive demand. Focus on areas with low crime, good schools, and amenities. Become a local expert and invest with confidence in a bright future. When analyzing properties, emotion ends and math begins. Focus on the numbers, cash flow and cash-on-cash return. Cash flow is your monthly profit after all expenses. Aim for at least $100–200 positive cash flow per unit. Cash-on-cash return shows how efficiently your money works for you. Many investors target 8–12% or higher. The numbers don't lie. They guide you to profitable decisions. Finding great investment deals is both an art and a science. Start with the MLS and sites like Zillow or Redfin, but remember, off-market deals and networking often lead to the best opportunities. Drive through neighborhoods, look for distressed properties, and reach out directly. Consistency is key. Analyze many properties, make offers, and don't get discouraged. Every no brings you closer to a yes. Found a promising property? Now it's time for due diligence. Verify the numbers, inspect the home, and review all financials. Always include an inspection contingency. This protects you if major issues arise. Attend the inspection, ask questions, and use the report for negotiations. Check leases, expenses, and zoning. If the seller won't provide documents or the inspection reveals big problems, don't be afraid to walk away. After your due diligence, it's time to make an offer. Work with your agent to prepare a purchase offer, including price, terms, and contingencies. Don't be afraid to negotiate. This is a business transaction. Once accepted, the property is under contract and the closing process begins. On closing day, you'll sign paperwork, pay your costs, and receive the keys. Congratulations! You're now a real estate investor. Owning a property is one thing, managing it is another. Your success as an investor depends on being a good landlord. Get your property rent-ready, screen tenants carefully, and use a strong lease. After move-in, collect rent, handle maintenance, and keep things professional. You can self-manage or hire a property manager. Either way, the goal is a safe, pleasant home for your tenants and a smooth investment for you. Every real estate investment comes with risks: vacancy, repairs, bad tenants, and market downturns. But you can prepare. Buy in strong rental markets, keep your property well maintained, and always budget for vacancies and repairs. Maintain a dedicated cash reserve for unexpected expenses. Screen tenants rigorously, and use a solid lease agreement. Focus on cash flow, not just appreciation, to weather market changes. With these steps, you'll protect your investment and sleep easier. As an investor, your mindset is just as important as the properties you buy. Don't let analysis paralysis stop you from taking action. Education matters, but real learning comes from doing your first deal. Remember, this is a business. Let data, not emotions, drive your decisions. Be conservative with expenses and use rules of thumb like the 50% rule. Build a strong team. Leverage their expertise. Focus on what you do best, and scale your business for long-term growth. Real estate investing is a long-term journey, not a get-rich-quick scheme. Patience and consistency are key. Your first property is just the beginning. Success comes from repeating the process, growing your portfolio, and learning along the way. Treat your investments like a real business, create systems, and keep your why in mind. With the right mindset and steady action, You can build lasting wealth for generations. You've completed the blueprint for real estate investing. From understanding the basics to building your team and evaluating properties, you now have the foundation to start your journey. The path is clear. Action is what separates dreamers from achievers. You're standing at the starting line, fully prepared. The opportunity is right in front of you. Your real estate journey starts now. Take that first step. The first step isn't buying a house tomorrow. It's defining your why. Open a notebook or document and write down your real estate goals, whether it's extra income, quitting your job, or building a portfolio. This simple action turns dreams into real plans. Assess your finances, start learning, and take small steps. The journey begins now. Your future self will thank you.